Welcome to Hibiscus Petroleum's Financial Results Webcast. This webcast presents an overview of the results reported as part of the quarterly financial report for the 3-month period ended 30th September 2017 and released earlier today. This webcast has been prepared by Hibiscus Petroleum Berhad, i.e. the company, solely for general information purposes only and shall at all times be heard and or viewed subject to the full quarterly report made available or published by the company on its website. This webcast may contain forward-looking statements which are based on current expectations, beliefs and projections about future events or matters. By listening to and or viewing the webcast, you agree to the limitations and notifications set out in the disclaimer section of this webcast. There are 5 parts to this webcast. In part 1, Pascal Hoss, Chief Executive Officer of C. Hibiscus Sendirian Berhad and co-founder of Hibiscus Petroleum, will take you through a brief introduction of the company. In part 2, Devarajan Indran, Vice President of Petroleum Engineering, will provide an overview of our main asset, the Anasuria cluster. In part 3, Yip Chi Yong, or CY, Vice President of Finance and Group Controller, will follow up with highlights of the company's first financial quarter results. In part 4, Pascal will briefly touch on details of our proposed acquisition of a 50% interest in the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract. He will then conclude with some of our key messages for this quarter in part 5. Should you have any queries, you may contact our investor relations team via the email address provided at the end of this presentation. I shall now pass you on to Pascal.
Hello, this is Pascal Hoss. I am a co-founder of Hibiscus Petroleum Berhad. I have also been recently appointed as the Chief Executive Officer of C. Hibiscus Sendirian Berhad. C. Hibiscus Sendirian Berhad is wholly owned by Hibiscus Petroleum Berhad and is the company that entered into several agreements with Sabah Shell Petroleum Company Limited and Shell Sabah Selatan Sendirian Berhad to acquire interest in the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract. Let me commence by providing you with a brief introduction to our company. Hibiscus Petroleum was listed on the main market of Bursa Malaysia in July 2011. We listed with the intention of being involved in both exploration and production activities. Initially, our activities were more focused towards exploration, but since 2014, when U.S. shale-related oil production catalyzed a drop in oil price, we have refocused our goals, concentrating the growth of our business by revitalizing mature producing assets safely and profitably in regions of our geographic focus. Our ownership of the Anasuria cluster of oil and gas fields in the UK North Sea, in this regard, is consistent with our goals and has been significant in generating positive cash flow and profit for the company over the past year. Through joint operatorship in Anasuria, the company is also fast gaining valuable operating experience in the UK as several significant projects have been delivered safely and efficiently. From Anasuria, we have been producing an annual average of more than 3,500 barrels of oil equivalent net to our company on a daily basis over the financial year ended 30th June 2017. Our current portfolio of assets is spread across 2 geographical locations, i.e. the United Kingdom and Australia. A further producing asset has been conditionally secured in Malaysia, and we are working towards meeting the conditions required to transfer the working interest in the 2011 North Sabah EOR PSC to us. Excluding our possible entitlements from the North Sabah EOR PSC, our company currently has a total proven and probable or 2P oil reserves of about 26 million barrels. This primarily consists of 6.5 million barrels of proven undeveloped reserves located in the Vic L31 West Seahorse asset in Australia and about 19 million barrels of proven developed reserves located within the various fields of the Anasuria cluster in the UK North Sea. We look forward to the completion of the Malaysian North Sabah transaction as it would boost the company's net entitlement reserves significantly. Dev will now take you through details on the Anasuria cluster in part 2 of this webcast.
Hello, I'm Dev Indran. I am Vice President of Petroleum Engineering. I'll now take you through some information on our key asset, the Anasuria cluster, which is located offshore the United Kingdom. To recap, we completed our acquisition of the Anasuria cluster from Shell and Esso on the 10th of March 2016 and have held the joint operatorship of Anasuria for about 18 months now. The Anasuria asset is located about 175 kilometers east of Aberdeen and has been producing since 1996 with an estimated remaining economic life of approximately 19 years. Our interest in the Anasuria cluster comprises a 50% interest in the Teal South, Guillemot A and Kite fields. We jointly operate these fields together with our partner Petroleum through a jointly owned legal entity incorporated in the United Kingdom called the Anasuria Operating Company. The cluster also includes the Cook field, and we have a non-operated 19.3% interest in this asset. Included as part of the Anasuria cluster are all the installed subsea production infrastructure and the floating production storage and offloading vessel, the Anasuria FPSO. Taking a look at the field layout, the subsea infrastructure underpinning the production of hydrocarbons is quite extensive and spans 25 kilometers from north to south. Our confidence to jointly operate this asset is derived from the existing knowledge and experience of Hibiscus and Ping personnel, some of whom have previously worked in the UK North Sea environment. Operating risks are further mitigated by the fact that we also utilize the services of Petrofac, a reputable international service provider in the role of offshore duty holder. During the first year of joint operations on the Anasuria cluster, we focused on understanding the asset, the environment we work in, and most significantly, we applied ourselves relentlessly towards improving operational performance. If you take some time to review a corporate business update that was issued by the company on the 9th of November 2017, you will be able to obtain more details of the results that have been achieved. Also covered in the corporate business update is information on several significant projects that have been recently completed at Anasuria and which we believe will make a positive impact on the performance of the asset going forward. The safe and successful execution of these projects have provided us a base for the more technically challenging projects that we hope to undertake in the next 6 months. That said, the financial performance of our Anasuria asset is subject to a few factors. We are exposed to movements in oil and gas prices. In this regard, we have seen in recent months that Brent futures pricing is currently in backwardation, which basically means that current spot prices are higher than futures pricing, a signal of near-term global oil demand. The recent gains in oil prices as shown in the chart here is also due to OPEC and its allies strictly complying to agreed production quotas as a means of managing oil prices. We believe that these oil price gains are sustainable as there has been minimal investment in exploration, development, and in some cases production enhancement projects in recent years to replace reserves produced during the period of low crude oil prices which commenced in mid-2014. Moving on now to the next factor that affects the performance of Anasuria. Foreign exchange rates also play a role as we recognize our revenues and valuation of Anasuria in US dollars, while the bulk of our operating costs for the asset are incurred in British pounds. But as a Malaysian listed company, we ultimately report our results in ringgit. Finally, as we cannot control the previously mentioned macroeconomic factors, we focus our efforts at managing the production performance of the wells, facilities uptime, and operational costs related to the Anasuria asset. Over the 18-month period under our joint operational control, several milestones have been achieved, which are reflected in the performance indicators shown on this slide. For today, however, I would like to review our operations for the period from July to September 2017. In this quarter, we recorded a lower average daily oil production rate of approximately 2,500 barrels a day compared to the average daily rates achieved in the previous quarter. Together with gas exported, our total oil equivalent production rate for the quarter was an average of approximately 2,700 barrels a day. The average facilities uptime for this quarter was 70%, also a decrease from the previous quarter. Generally, the operational performance for this quarter is lower than previous quarters, but it is in line with our expectations. This is because the company had commenced a planned 31-day offshore turnaround project that saw the total shutdown of the Anasuria FPSO for the purpose of carrying out planned maintenance activities. It is important to note that whilst we are reporting a lower uptime metric and subsequently lower average daily production rate this quarter, our careful planning of the timing of the offtake of the oil produced of approximately 250,000 barrels sold at $51.54 per barrel at the end of August and prior to the planned commencement of turnaround activities has allowed us to continue our sequence of profitable quarters. Although operational expenditure has not significantly increased with the planned offshore turnaround project, the lower achieved average daily production rate has resulted in a higher OPEX per barrel metrics for the quarter of about $23 a barrel. As mentioned in the previous slide, the decrease in facilities uptime and hence a lower daily average production rate was due to the 31-day offshore turnaround of the Anasuria FPSO, which commenced in mid-September 2017. The offshore turnaround project is important as we believe we have made the Anasuria FPSO a safer work environment, and we also hope that this project will result in the facilities uptime metric increasing towards 90% in the coming months. Barring unforeseen circumstances, our next offshore turnaround of the FPSO is expected to be in late 2019. As recently disclosed in our corporate and business update dated 9th November 2017, the company is excited by the future potential of Anasuria. Operationally, the company is fast gaining valuable experience in the UK continental shelf, as significant operational projects are being delivered safely and efficiently. In addition, the delivery of several production enhancement projects during this 2017 calendar year has helped us arrest the natural production decline normally seen on all mature oil and gas fields. Although the offshore turnaround project has negatively impacted certain performance metrics specifically for this quarter, we believe that oil prices going forward are going to be stronger, and it will be a commercial advantage in the coming months to be able to produce our crude on the back of higher levels of facilities uptime and market it at a higher oil price levels. There is also some excitement in the company as we gear up to execute additional production enhancement projects in 2018 and 2019, which could deliver up to a total 5,000 barrels per day of oil net to Hibiscus. 2 of these projects are in an advanced stage of implementation, and we will keep you all appraised of progress from time to time. I will now pass you on to CY for part 3 of this presentation.
Hi, I'm CY, Vice President of Finance and Group Controller, and I'll take you through the financial highlights for the quarter. In the first quarter ended 30th September 2017, the Anasuria segment reported earnings before interest, tax, depreciation and amortization, or EBITDA, of approximately 33 million ringgit. This represents an approximate 40% decrease in EBITDA when compared to the immediate preceding quarter, and a 23% increase to the previous year corresponding quarter. The EBITDA margin of 58% this quarter decreased from 75% and increased from 51% when compared to the preceding quarter and corresponding quarter respectively. Our EBITDA margin was impacted by a higher OPEX per BOE cost, which itself was a result of the execution of planned maintenance activities. As can also be seen, the Anasuria segment contributed a profit before tax of 19 million ringgit and a profit after tax of 20 million ringgit for this quarter. Whilst profits are extremely important, management's focus remains on delivering strong and sustainable EBITDA levels, as business continuity is of the highest priority. Over the past few quarters, our balance sheet has been gradually strengthening. We have built our total assets and shareholders' funds to 1.3 billion and 770 million ringgit, respectively. The cash position of the group is also healthy, with cash and bank balances amounting to 32 million ringgit. In addition, for the first time since the quarter ended 31st December 2015, the group is now in a net current assets position. You will also recall that when we purchased the Anasuria cluster of assets, there was a component of the total purchase consideration of $52.5 million that was deferred. This deferred component of the purchase consideration amounted to $22.5 million. On the 10th of March this year, we fulfilled a payment obligation of $15 million towards this deferred consideration component. Further to this, we have on schedule fulfilled our payment obligation for the final tranche of $7.5 million on the 8th of September this year. I will now hand you back to Pascal to provide a brief recap on our proposed acquisition of a 50% participating interest in the Malaysian 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract, or PSC.
In October last year, we announced an exciting new proposed acquisition when we entered into a conditional sale and purchase agreement with Shell. This transaction entailed the acquisition of Shell's entire 50% participating interest in the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract, or PSC. The SPA also includes interest in the joint operating agreement currently between Shell and Petronas Carigali in relation to the PSC. This transaction marks our second deal with Shell internationally and is consistent with the group's strategy of having interests in producing late-life fields in safe jurisdictions. We are working relentlessly towards making the transaction unconditional because this asset has the potential to increase the company's oil production output by a factor of up to 3 times. Not only that, this asset will provide the group with a second revenue stream which is independent of the Anasuria cluster. And it gives the group the opportunity to strengthen its technical and operational capabilities. The North Sabah EOR PSC has been producing since 1979 with production rights until 2040. The deal includes the operatorship of 4 producing oil fields offshore Sabah, the operatorship of the Labuan crude oil terminal, and all other equipment and assets related to the PSC to be transferred to Hibiscus Petroleum. As reported by Shell, at the end of 2015, the asset had an average daily oil production of 18,000 stock tank barrels per day. Our independent valuation, performed by Risk Operations Private Limited, estimated the asset to hold 62 million barrels of remaining reserves and 79 million barrels of contingent resources. Overall, we believe this asset holds a great deal of potential. On 29 May 2017, we announced that Petronas Carigali had waived their preemption rights under the joint operating agreement with Shell. In our announcement, we also stated that Petronas had provided its conditional approval to Shell for the assignment of their interest in favor of C. Hibiscus. Since the signing of the transaction documents, we have made considerable progress towards the transfer of operatorship, and we hope to be able to complete the transaction in the near future. Before we wrap up, I would like to highlight a few takeaway points. As we have demonstrated consistently, the Anasuria asset has transformed and is continuing to positively impact the financial performance of the company. Our EBITDA and profit numbers continue to be strong in a landscape where oil prices have ranged between $45 and $50 per barrel. Strong EBITDA performance has enabled reinvestment into the asset to be crystallized. We believe some of our investment has arrested the natural production decline of this mature asset, and we also hope that our investment in the planned recent turnaround of the FPSO is timely so that we are able to enjoy higher levels of facility reliability and availability at a time when oil prices appear to be in backwardation, indicating a gradual tightening of supplies. This financial year is expected to be exciting as we plan to execute capital projects in the North Sea and complete the acquisition of the North Sabah asset.
And that's all we have for this quarterly earnings webcast. Thank you for tuning in.